Well, friends, let us start our today's class. Welcome to all of you. Yeah, so before starting that receivable management, as we are discussing, that quickly I will see the doubts that you had asked. I'm going for screen sharing now. Just wait a minute. I think screen is visible to you.
Yes, sir.
Yes, sir.
Okay. So I'll go to a particular slide. Just a minute. Yeah. So this is the question we are talking about, and this is from your study material. This particular question, I think,
So
question number
this is
Question number 8, Rosalie, you had asked yesterday.
yes, sir. It is already discussed by
Yeah,
you
yeah, yeah. I
yesterday.
already discussed. After that, also, I got some queries from someone else. Many people think that these probabilities, let me tell you, this is, I think, question number 8 of your study material. Is it?
Yes, yes,
Question
sir.
number 8 of your study material. I will suggest all of you to see it and to solve this particular question. Perhaps this is the only question which is available in the study material which talks about this cost, this the stock out cost calculation, right? And many people still feel that these probabilities which are taken in the study material are wrong. It's not wrong, as you have understood, we have discussed that we will be computing the probabilities in this following manner. I'll be explaining you once again very quickly. This particular question has got three parts. First part is about this is about example number 8 in the study material, ICSI study material.
Yes, sir. Yes,
First
sir.
part of the question talks about computation of EOQ. That is no issue. You know the formula, you'll be able to do it. And the last part of
Yes,
the
sir.
question C, it talks about this is classifying the stock into A, B, and C categories on the basis of value. You can do it. That is also not a difficult thing. But the only challenge in this question is that middle part, that part B. Part B, under this part, we are supposed to compute the stock out cost. Here, the question says these are the possibility of the stock out. The possibility that 5 units will be stock out or 400 units can be stock out, or 100 units or 50 units or 0 units. These are the possibility of stock outs. That means there is a possibility that at certain time this much of stock will not be available. The factory will be out of stock. Okay. And
Yes,
what is the probability of 500 units will not be there? What is the probability?
one.
1. 1 means 0.01. 1%. 1%
Yes, sir.
means
Point
zero. Point 0.
0.
Similarly, 400 is
Yes.
zero point 0.02. Okay. 250 is 0.03. 100 is 0.04. 50 is
0.05.
0.1. Okay. And the possibility of a no stock out is zero point 0.8. If you add all these things,
Yes, sir.
total you will be getting 100.
Yes,
Okay.
sir.
Stock out cost is rupees 40 per unit. Carrying cost of inventory is rupees 20. Determine the optimal level of stock out inventory, meaning how much of
Stop.
safety stock you should keep so that stock out cost will be minimum. That is the question. Okay. But still, repeatedly, every batch I find students are getting confused. They feel the raw study material calculation is wrong. It's not so. We need to understand that how this calculation can be done. This part only, that part I'm explaining here. Okay.
Yes,
So
sir.
first, once again, I'm explaining what I had explained you earlier already. That this is the table with the help of which you will be able to decide that what should be the safety stock, ideal safety stock, so that stock out situation will not be there, right? So let us first assume the safety stock is zero. If safety stock is zero, then these are the possibility of the stock out. 500 units, 400 units, 250 units, 100 units, or 50 units. And these are the probability. For 500 units, probability is 0.01. 400 units,
Yes, sir.
0.02, like this. Is it done?
Yes,
Okay.
yes, sir.
So consequently, stock out cost you can calculate. Expected cost multiplying it with the probability you can find it. Okay.
Yes, sir.
right? That's okay. Now, if I keep safety stock of 50, my stock out will not be 500, it will be 450 because 500 minus. If I keep safety stock 50, my 400 possibility of 400 stock out will not be there, it will be 350. Okay. So, like this, I can
Yes, sir.
calculate
Yes.
450, 350, 240, and the probability will be the same probability 1, 2, 3, 4 will be here. Not all these four probabilities I am taking it here. These are the probabilities. Okay. Accordingly, I can
Yes, sir.
calculate stock out cost and the expected cost. So if I keep zero safety stock, my stock out cost is 2,800. If I keep 50 safety stock, my stock out cost is how much?
1620.
1620. If I keep 100 units as safety stock, my
840.
my probabilities will be like this.
800.
These
Yes,
three
sir.
figures 0.01. Okay. And my stock out will be 400, 300, 150, etc. Okay. If I keep 250, then my stock out units only either 250 or 150. Probability will be 0.01 and 0.02. Like this, expected costs are calculated.
Yes.
Okay. Very simple.
Yes, sir.
Right. So if you go from bottom to top, you'll find you'll be able to understand the solution which is provided in the statement. Okay. If you travel from top to bottom, it may be difficult for you to understand how these units are arrived and what is the reason where from this probabilities figure has been picked up. Understood? That's the only catch in the question,
Yes.
but you have to remember this concept. Once you know that expected cost of the stock out, then other part of the cost is also available with you, like carrying cost is available. So total cost you can find it out. So where total cost is minimum, that much of safety stock should be kept. That's the concept,
Yes.
right? So if I keep on increasing safety stock level, my stock out cost will be reducing, but my carrying cost will be increasing. But I have to look at the total cost. Total cost is minimum here. If total cost is minimum, I have to keep 50 units as
Yes,
safety
sir.
stock. Okay,
Yes,
okay.
sir.
So this question you must solve, must understand this concept. And then next part of the question we have discussed, I think you'll be able to solve how to categorize them in A, B, C category on the basis of value. If you arrive at the percentage of the total cost, you can look at this solution later on, right? Okay.
Yes, sir.
And you had a doubt regarding reorder quantity and reordering level. I had explained you earlier. What is reorder
Yes.
quantity? Can you reply?
It is EOQ, defining EOQ.
EOQ. EOQ. That's the quantity for which you are going to place order. And what is reorder level?
Reorder level is the point at which we place the
And the point at
order.
which here you see this is the reorder point, is the safety stock,
Yes, sir.
and this is this quantity what you are ordering. Ideally, you should order EOQ. Okay.
Yes, sir.
Okay. And always when we are calculating carrying cost, you have to remember that when you place an order, full amount of stock, full what you place an order of for EOQ quantity for EOQ, what will happen?
Yes,
At that point of time, we'll be having full stock or maximum stock.
yes,
Gradually,
sir.
stock will come to zero level or up to safety
Yes,
stock
sir.
level. Okay. Then new order will be
Yes,
placed and immediately new order will be arrived. So sometimes we might be having maximum stock, sometimes we might be having safety stock.
yes,
Okay.
sir.
For calculation of carrying cost, we have to see on an average how much of stock we are carrying. Carrying cost has to
Yes,
be
sir.
calculated on the average stock. That concept also you have
Yes,
to. Okay. And the concept of lead
yes,
time also you have understood. It's the time
yes,
gap
sir.
when you place the order and finally when you receive.
Receive the order.
That is called as
Yes,
the
sir.
lead time. And maximum stock level, minimum stock level, reorder level, danger level, right?
Yes, sir.
All these concepts are there in the slides and we have verbally discussed all these things. I think you'll be able to solve this question. I think this was one more doubt you had asked for. This has been clarified,
Yes, sir. Yes, sir.
right? This question
Yes,
also
sir.
you had sent me, right? What is 2 by 10 net 650? I told you once I clear this receivable management, I after that thing only I'll be explaining you what is this. Now coming to receivable management part. Receivable means what you understand by receivables.
When debtor pays
Yeah, it is the
back
Sunday
payment.
debtors. So every business house
Yes,
or
sir.
every farm has some amounts of debtors. When goods are sold on credit, debtors are created. Now it becomes a problematic thing how to manage debtors. So how to take care of this receivable part. So one should have right mental attitude to control the credit sales. Credit should be under control. There should be clear credit practices, right? To whom credit has to be given, to whom it should not be given. That decision should be there. And the credit practices should be clearly understood by the sales staff because they are the people who are executing the decisions. Okay, who are
Yes, sir.
implementing the decisions which are taken. And one should be professional in accepting new accounts. For a new credit sale, one should behave in a professional manner. It should properly evaluate, and after that only it should take the decision whether credit sale should be made or not. To check out each with each with each customer whether credit should be allowed or not. To establish credit limit like this, so many aspects has to be taken care of. One should continuously review these credit limits, right? Keep very close to your larger customers. So one should be in touch with larger customers. Invoice should be made promptly, right? Also, you may think of charging some penalty if there is some overdue. If someone is delaying, you may charge, you may levy some penalty for that. Consider
Yes, sir.
accepting credit cards or debit card payments. Monitor your debtor balances. So all these are create a aging schedule that means how much of debt is more than 1 month old, how much of debt is more than 3 months old, how much of debt is more than 6 months old. Like this, you can create an aging schedule so that you can monitor your credit balances. Okay, so these are some issues credit receivable deals with all these things. These are the three aspects which comes under credit management. One is credit policy, credit analysis, credit policy.
Yes, sir.
Company has to or the business has to take decisions how this credit sales needs to be executed. How risky is credit sale? That analysis has to be made. Then control over receivables. Receivables needs to be controlled. That policy needs to be executed. So these are the three major aspects of credit sale, credit policy. Coming to credit policy, you know, if you give or if you make credit sale, the first thing is that sales may increase, but at the same time you are taking more risk. So one has to
Yes.
go for a kind of trade-off kind of thing that how much risk one can take in order to increase the sales, right? And in the process of credit sales, what happens? Your cash or the bond gets locked off, so you lose interest. It also involves a kind of carrying cost. Is it?
Yes, sir.
So normally, when you're talking about the credit policy, the decision of credit policy involves these issues like what is the rate of cash discount one should offer. If someone is offering cash immediately is paying cash for the sales, then what kind of discount we can give to them? And what is the cash discount period? That means suppose you can say if someone pays in 30 days, then this cash discount will be offered. That period has to be decided. That within how many days one should pay so that he can avail the cash discount. Net credit period. Okay, how much credit period is allowed by me, by my supplier, how much credit period is allowed by my supplier, and how much credit period is allowed by me to my, let us say, purchaser, is it not, to my customer. Suppose my supplier is giving me, okay, you can say 30 days credit, but I am allowing 45 days credit. So the net credit period is 15 days. Is it not? So ultimately, I am giving a credit of 15 days because my supplier is allowing me 30 days. Understood?
Yes, sir. Yes,
That
sir.
is also, that concept also comes under decision about credit policy. Certain variables are associated with credit policy. You have to decide the credit standards, that means the general guidelines How will decide a customer to whom credit sales can be made? Credit policy also deals with credit period, cash discount, collection programs, how money can be collected. What is the desirable level of receivables? How much you can keep as a debtors? That aspects are also dealt with credit policies. These are some more factors, some factors that determine the credit policy. First is effect of credit on sales volume. If I make credit on sales, what will be its impact on the volume of sales? Right? Credit terms. What kind of credit term I should decide? I should include in my credit policy. Cash discount. Policies and practices of firm for selecting credit customers. Paying practices and habits of the customers. Firm's policies and practices for collection. Degree of operating efficiency in billing, record keeping, etc. How fast your organization is able to raise a bill, how fast organization is able to collect the payment. All these factors are relevant for deciding credit policy.
A credit term defining debtor is or anything else?
Credit terms and
I'm asking that credit term is defining debtor is.
credit term is defining debtor age. That's your question.
Yes, sir. Like,
No, no, it's not like this. Credit terms is on which, what are the terms on the basis of which you are allowing credit sale. Okay, suppose you may
okay, sir.
decide my terms is that credit sale you should pay uh, maximum within 45 days. That is the terms of credit sale.
Yes, sir.
Okay,
Yes, sir.
okay,
Yes,
right. Or if you make further delay, you'll be charged with an interest of 2%. That is the terms of credit sale. So
yes, sir.
these terms and conditions are called as credit terms.
Okay, sir.
Okay,
Yes, sir.
or you should minimum you should have purchased this much of amount. Minimum only when your bill exceeds 1 lakh rupees, then only will kick up credit sale. Or maximum amount of credit sale can be like this. So these are certain terms which can be decided.
Yes, sir.
They are called as credit terms.
Yes, sir.
Okay, as a finance manager, we need to understand what is the role, of a finance manager with relation to credit sales. So finance manager can supervise the administration of credit. Finance manager can contribute to top management decisions relating to having a relating to decisions for best credit policies. He can help in deciding the criteria for selection of credit applications. He can help in speeding up the conversion of receivables into cash. There are various methods through which cash credit receivables can be converted into cash. He may take some loan against the receivable, or he may go for factoring services, etc. These concepts we'll be discussing shortly. So these are the area where finance manager can be helped. How to make better credit decision? These are the four C's normally it is called as C for character, C for capacity, C for capital, C for conditions and types. These aspects are taken into consideration to take better credit decision. We need to see what is the character of the customer, whether he has got paying capacity, whether our capital is permitting to allow credit sales, and what is the condition of the bank. So all these things are taken into consideration for taking better credit decisions. There are other methods of managing credit receivable, like loans secured by receivables. Receivables are, they are means debtors, meaning they are a kind of assets. So these assets can be secured and a loan can be taken against them. Then one more kind of service is called as the factoring of account receivables. Here what happens? These receivables, which are in fact the assets or current assets of the organizations, are sold, right? Are sold to a party who is called as the factor. Then various decisions can be taken on the credit policy. Okay, through which credit the receivables can be managed. One need to control over bad debts whenever we are making credit sale. Bad debt is an important issue. So credit policy need to be designed in such a way that bad debt aspects are taken care of. One may go for periodical checks right? You may classify like debtors for more than 30 days or 30 to 60 days, 60 to 90 days, over 90 days, like this one can analyze. And you may continuously follow the old debtors, let us say debtors which are from whom debts are outstanding for more than 60 days, needs to be followed up more seriously. This is how bad debts can be controlled. Now, here we are going to learn one particular way, or you can say particular technique of managing receivables called as pledging. Pledging means what happens? A farm pledges its accounts receivable or pledges its debtors as a collateral and obtain a short-term finance, maybe from a bank or from some financial institute. By pledging these debtors, one can get a finance. It's a kind of loan kind of thing. The lender may advance 70 to 80% of the bill amount. Suppose your debtor amount is 100 lakh. So you might get 70 lakh or 80 lakh. 70 to 80% of the bill amount can be obtained by way of loan. Okay. Usually the lender conducts a thorough investigation and determine the quality of receivable. If showing my receivable is 100 lakh, but actually 100 lakh will be recovered or there will be some bad debt. That investigation is conducted by the lender. After that only it advances 70 to 80%. This concept is called as the pledging. Did you understand this? What is pledging?
Yes, sir.
Okay, pledging means you can say by offering security. Here the
Yes, sir.
details are offered as security and loan is advanced by the lender. Okay,
Yes, sir.
right? This is called as pledging. Then other important concept here is factoring services. Here what happens? Account receivables are sold. In fact, we sell the entire account receivable to a company which is called as a factoring company. Okay, so normally the factor buys it at a lower price, less than the face value. Suppose your account receivables are 100 lakh, the factor might buy it as 90 lakh. The difference 10 lakh is factor's margin. That is
Yes, sir.
factor's profit. Okay, and factor also takes the risk. Suppose out of 100 lakh, enter 100 lakh will not be recovered. There are, in fact, broadly two kinds of factoring. One is called as with recourse, other one is without recourse. With recourse means suppose uh, you have a business and you are availing factoring services, right? You have sold 100 crore worth debtors. Suppose there will be some debt, suppose some bad debt. If debtor takes the entire risk, the bad debt is the risk of the debtor. That is called as the without recourse factoring. That means the factor will never ask you that how much of that debt became bad. Factor will
Yes,
never ask you to compensate, right? But if it is a factoring with recourse, then bad debt is your responsibility. If there will be some bad debt, if your debtors are not paying, then factor will recover that amount from you. Understood? Other kind of factor we'll be learning, the other kind of factoring services we'll be learning. So now we have understood there are broadly two kinds of factoring. What are they? Can you tell me now? One is with recourse, other one is without recourse. Okay.
sir, can you explain the first one again?
What is with recourse and without recourse? Right. I'll be explaining you
With
shortly with all other kinds of. First one means you're talking about the factoring, no?
recourse.
What is with recourse and what is without recourse? Right. Both the things I'll be explaining you shortly. Just wait a minute. Various kinds of other kinds of factorings are also there. At that point of time, I'll be explaining. First, you understand the broad concept of factoring, then I'll be telling you what is with recourse and what is without recourse. Okay. Are you seeing this picture?
Yes, sir.
Okay. Here you see in a simple factoring, these are the three parties involved. Who are these three parties?
Debtor, company, and factor.
Okay. Debtor, company, and factor. So what happened? Company sells goods on credit to a debtor.
Yes, sir.
Okay. So that is the
Yes,
condition.
sir.
The debtor was supposed to pay to the company in
Yes,
due
sir.
course. Is it done? But here what will
Yes, sir.
happen? The company has sold, in the company's balance sheet there will be a debtor balance. receivable.
Yes, sir.
These receivables are assigned to a factor. That means factor has purchased that receivables.
Okay, sir.
Okay, what factor will they pay? Factor will pay a discounted amount. Suppose this amount was 100, factor may pay 90.
Yes, sir.
Okay, so 10 rupees is the profit of the factor. The benefit of the company is that company is getting immediate cash. Otherwise,
Yes, sir.
company would have to wait till the time when the debtor makes payment.
Sir, here who will collect the receivable? Company or factor?
Factor will collect
Okay, sir.
because this is sold to the factor. The debt is sold to the factor. Factor will be collected.
Yes, sir.
Okay. So company has assigned the receivables and factor will make a payment.
Sir.
Okay. Now the debtor pays the amount after expiry of the credit period to whom? Debtor pays to whom?
Factor.
To the factor. Okay. Now question is that if some amount becomes bad, if there is a bad debt,
Yes, sir.
okay, if there is a bad debt, and if it is without recourse factoring, then factor is not responsible for the bad debt. That is factor's risk. Understood? If it is without recourse factor. If it is with recourse, if it is with recourse, then what will happen? The factor will again ask the company, you had sold this much of bad debt, this much of debtors, but you see they are not debtors, they are bad debts. So you have to
Yes,
collect
sir.
this money. Are you getting me?
Yes, sir. Yes, sir.
Okay. So without
Yes,
recourse
sir.
means risk is entirely factors. It is entirely
Sir,
factors.
here factor will collect the money completely from debtor.
Yeah, factor will be collecting money completely for the debtor. Even if there is some bad debt, it is the factor's responsibility.
Okay, sir.
Okay.
Yes, sir. Yes, sir.
So many companies avail these factoring services because otherwise what happens? Money is the funds are blocked. So company can get immediately cash by converting these receivables into by selling this receivable to the factors. Company can get some cash. That is the advantage of factoring. Okay, so it is a kind of service through which debtors are outrightly sold to a company called as the factor. Factor collects the receivables on due date. Okay, it also assumes the credit risk associated with the collection of the account. Okay, various types of factors will be also understanding. So as you know, as you are telling here, the trade debts or trade receivables or debtors are sold. Factor may be with recourse or without recourse. With recourse means in the event of bad debt, factor can approach the supplier if it is with recourse. And without recourse means factor cannot approach to the supplier, cannot approach to the company. It is his own risk. Understood?
Yes.
Factor also provides some incidental services like collection functions such as loans on inventory, loans on fixed assets. Okay, these kind of additional services sometimes factors are provided. Some advisory services they also can provide. Credit and collection function they do. Credit protection function they do. These are the advantages of factoring service. Factoring is different from account receivable loan. When you talk about account receivable loan, what happens here? Against your account receivable, against your debtors, you take a loan. And your
Yes,
account
sir.
receivables are offered as a security.
Collaterals.
Okay.
Yes, sir.
But when you talk about the factoring, the account receivables are sold to the factor. It's the outright sale of the receivables.
Yes, sir.
Okay. In case of account receivable loan, what happens? The banker may charge some handling charges. In the factoring, it is totally sale.
Yes, sir.
Okay. And factoring is also different from bill discount. In bill discount, what happens? If the supplier, the person who has accepted the bill, who does not pay, it becomes the responsibility of the seller. Is it not? But here, if you are
Yes,
going
sir.
for without recourse factoring, then seller has got no responsibility. Once it is sold to the factor, entire risk is with factor. Okay.
Yes, sir.
And this following steps talks about what are the mechanics of factoring. First, seller negotiates with the factor. Seller talks to the factor that I have a plan to sell and these particular debtors which will be created that will be offered to you for factoring. Seller
Yes, sir.
requests a credit check on buyers. Then factor checks the credit credentials and approves the buyer. First factor approves the buyer. Then seller sells the goods. Seller sends the invoice to the factor. Okay, seller sells the goods and seller is sending the invoice. But before that, the factor has already checked the credit credentials and approves the payment. Okay, then what will happen? Factor send a copy of the invoice to the buyer. Factor advises the payment. Factor advises the amount to which seller is entitled. Okay, on expiry of the agreed credit period, the buyer makes payment of invoice to the factor. So buyer will make payment to whom? To the factor, right? And factor pays the residual amount to the seller. So normal what happens? Initially, factor may pay some amount. Let us say initially it may pay 20%, later on pay 80%, or initially it may pay 80%, later on pay 20%. Once the final amount is settled, factor pays the entire. Okay. This picture will also explain you how transaction happens. Now you see here is a customer, here is a client. Client is making credit sales to the customer. Okay. And invoice is raised. Then client, what happens? Contacts the factor.
Yes, sir.
Okay. Submits the invoice copy to the factor. Factor initially pays 80%. And in due course, customer pays to the factor and factor pays the balance money. Understood the process?
Yes, sir.
Okay. This is how factoring service works. And coming to various types of factoring, quickly we'll be seeing this kind of types of factoring. One is full service or without recourse factoring. That means the full responsibility is with the factor. It is called as the full service factoring or without recourse factoring. That means if something goes wrong, factor will not ask you for help.
Yes, sir.
Okay, full responsibility of the factor. Okay. Next is this should be point two should be actually with recourse factoring. With recourse factoring means factor does not assume the credit risk. First case is without recourse. Second case it should be please read it as with recourse. With recourse factoring. Okay. Factor does not assume credit risk. Credit risk is with the sorry. This one is written factor. In this case, factor does not assume the credit risk. When the factor doesn't assume the credit risk, then what kind of factoring is it? This is in fact without recourse.
The first one is without recourse.
Yeah, it's right. Okay. So the difference between there is a printing mistake here, typographic error. As I told you from the very beginning, when the factor assumes full responsibility, that is called as without recourse factoring. Okay, so in first case it's the full responsibility, that is without recourse factoring.
Okay, sir.
Okay, when it factor does not assume responsibility, here factor is not assuming responsibility, it should be with recourse factor.
Yes,
Okay,
sir.
so here there is a typographic error, this should be with recourse factoring second part. Okay,
Sir.
third one is maturity factoring. So that can be, there is a possibility that sometimes factor pay around 75 to 80% of the factoring amount immediately. That is called as the advance factoring. Okay. Or sometimes factor pays only when money is received from the debtor. That is called as the collection factoring. So maturity factoring means when the factor pays at the time of maturity. Or there is one more concept is there, which is called as the bulk factoring. Bulk factoring means the factor first discloses the fact of assignment of the debt to the debtor. Factor first discloses, or it is, or you can say the debtor is notified that this particular debt is going to be factored. At the time of sale itself, he knows that he has to pay money to the factor. That is called as the notified factoring or disclosed factoring. But is
Sir,
undisclosed factoring means the debtor
informing
does
the
not
debtor.
know this. The debtor does not know that this particular debt is factored. Okay. Here, what will happens? The seller himself collects. Collection of the debt are done by the client himself. Debtor is not at all informed about the factoring. Factoring is done in a, you can say it is done in a kind of undisclosed manner. Okay, that is called as undisclosed factoring.
This
Agency
case,
factoring.
company.
Yeah, tell me.
In third case, company
I'm unable
on
to.
in undisclosed factory
Yeah,
will collect the money.
who will collect the money? Collection is done by the company.
Okay, sir.
Okay,
Yes, sir.
collection is done by the company and it is handed over to the factor,
Okay, sir.
because actually debtors are sold. Debtors are sold to the factor, but that is kept hidden.
Okay, sir.
Okay, the debtor is not aware that his debt is sold to the factor. So therefore, collection is made by the company and it is shared with the factor.
Yes, sir.
Agency factoring, here what happened? The factor as well as the client share the works. That means some of the activities are done by the company and some of the activities are done by the factor.
Yes, sir.
Okay, suppose normal sales ledger administration can be done by the company, collection one can be done by the factor. Like this share the entire factoring one. That is called as the agency factoring. International factoring, as you understand, it's called as the cross-border factoring, the factoring where different countries are involved. Limited factoring, your factoring is not done for all invoices, but only for some limited invoices. Buyer based factoring, here what happens? The buyer arranges the factor. Normally, what happens? Seller arranges the factor. Is
Yes,
it
sir.
not? The seller or the company sells its debt to the seller. But if it is routed through buyer or the buyer is arranging a factor, that is called as the buyer driven or buyer based factor. So like this, various kinds of factoring is there. But what is most important for us is to understand what is with recourse factoring and what is without recourse factoring. Okay, that is what you need to understand. Okay, I repeat once again. What is with recourse? With recourse means
The
factor is not taking the entire risk. Here, risk means risk of bad debt.
yes, sir.
Okay, without recourse means factor is taking the entire risk. Okay, here risk means risk of bad debt. Okay, I had a plan to do this example today. Uh, Let us see if time permits. Can you just quickly read this question or quickly note down this important key points of this question so that we'll be solving this question.
Shall I read?
Yeah, please read.
The turnover of Jenny is rupees 100 lakh, of which 70 is on
Your voice is breaking. Meghna, can you read?
the,
Yes, sir.
Yeah, please read
The
it.
turnover of Zenith Limited is rupees 100 lakh, of which 72% is on credit.
Yeah.
Debtors are allowed 1 month to clear off the dues. A factoring company is willing to advance 80% of the bill raised on credit for a fees of 1% a month plus a commission of 5% on the total amount of debt.
So you see, factory is charging two
Zenith
things. Fee of 1%. 1% means 1% of credit sale. You have to find out how much of credit sale. Right?
okay, sir.
Now, 1% of credit sale, no, not exactly that. Advance. Factory is giving 80%. So 80% 1% we have to calculate. Okay. Okay.
Yes, sir.
All these 80% and 1% calculated on credit sale.
First we will calculate what is credit sale. Then we will calculate what is 80% of that. Right? Then we will calculate what is 1% plus commission we have to calculate. Now, next point.
Zenith Limited has a result. This arrangement is likely to save rupees 48,000 annually in management cost and avoid bad debt at 1% on the credit sales.
Right.
A bank a bank has come forward to make an advance equal to 80% of the debt at an annual interest rate of 15%. However, it is a processing fee will be at 1% on the debt. Would you accept factoring on the offer from the bank?
Okay. So, friends, what we will do? We'll see there are two options whether we'll go for factoring or whether we'll go for bank loan. Okay. Both the ways we can do it, which is beneficial, we have to do. So, how to solve is I am going to show you the format. You have to calculate what is annual credit sale, what is monthly credit sale, what is 80% of the that, how much fee is to be charged, how much commission is to be charged. If I go for factoring, I'll be saving management cost, saving bad debts, and what is the net cost of factoring. This is what you calculate. We'll be discussing this problem tomorrow. And similarly, you calculate what is the cost of if you, what is the amount, what is the cost of bank finance. Then we'll compare both the things. Okay, we'll stop here today. Time will not permit us to go further. So tomorrow again we'll be having a class. We'll be discussing this particular question.
Yes, sir.
Is
Yes,
it
sir.
okay?
Yes, sir.
So tomorrow we'll start from this question, and probably tomorrow we'll be able uh, to close this chapter. Then we'll be moving to the next chapter.
Yes, sir.
Okay. Thank you very much.
Thank you, sir.
Sir.
Thank you.